Hi everyone, welcome back to Stephan Livera podcast, brought to you by Swan.com, the best place to buy Bitcoin. Joining me today is Adam Sullivan. He is the CEO of Core Scientific. Adam, welcome to the show.
Thanks for having me on.
So Adam, let's start with a little bit about yourself, how you got into Bitcoin, and maybe a little bit on how you came to be the CEO of Core Scientific.
Yeah, absolutely. So I first got into Bitcoin back in 2016. Came at it from a mining perspective. So actually, one of the traders that sat next to me at the fund I was working at left to go start a crypto fund, and he convinced me to start looking at mining because he thought it would fit my skill set very well. So I left the fund, was working on some mining stuff, and actually joined an investment bank as part of that as I was looking for investors to build out my mining business. So started working with publicly traded clients, all non-crypto focused companies back then, right? It was 2017. I would say every public company was interested in the space. And it was a really great introduction to working with public companies. And by the time 2019 rolled around, we started to actually see, for the first time, many of the first crypto focused companies. I was really focused on mining at the time. In 2018, I actually did a tour around the United States, seeing about 60 to 70 sites. Back then, 5 to 10 megawatts were big sites, right? And so we started working with a public traded company back then focused on mining, worked with them up until I left the investment bank. But we had one of the largest investment banking practices focused on crypto and mainly Bitcoin mining specifically. And so it was a really exciting time. We took companies from being small, less than 5 people teams with one site to really what we see today, which is public companies with multiple mega sites and really robust, I would say, public markets strategies. So it was an exciting build out time, but that actually also brought me to Core Scientific. So back in 2023, we were about 5 months into a Chapter 11 process. I'd actually helped take Core Scientific public previously and advise them on some of their M&A activity. And so when they were looking for new leadership, I was brought on board back in April of 2023, and I've been a part of the company ever since.
Great. And maybe if you could, although I'm sure some of this is perhaps before your time as CEO, but if you could sort of take us through what happened. I think listeners would probably be interested to hear a little bit about that process of going through bankruptcy.
Yeah, so let's take a step back and go back to 2022. So 2022, notable crypto winter, obviously a lot of failures throughout the course of 2022. Core Scientific was probably highlighted by the fact that, we decided to put a significant amount of Bitcoin on balance sheet while taking on a significant amount of short-term amortizing debt. Now, you have to think about your balance sheet strategy. If you're going to hold a significant amount of Bitcoin on balance sheet, you can't have short-term, short-dated debt that in a volatile business, you have to be able to service that debt on a US dollar basis. And so, really, that was really one of the main struggles. It actually wasn't a large portion of our debt that put the company into Chapter 11. It was actually a very small portion of the debt that amortized over a very short period of time. And so, really, to balance sheet strategy is what's necessary to run a Bitcoin mining business, right? You can see it with some of the other pubcos who have been able to put a significant amount of Bitcoin on balance sheet. It's also because they're pairing it with matching their US dollar denominated liabilities with cash on balance sheet as well. But the Chapter 11 process, those are difficult to go through. They're difficult for any type of company. Luckily, we have a very strong asset base. We have a very strong team that stuck with us throughout the course of the process. And we did a lot of firsts in the Chapter 11 world. We paid off our financing through the course of the bankruptcy process, which is very unusual. We were a solvent debtor case, and actually one of the most successful solvent debtor cases in history, meaning the recovery to equity holders is one of the highest that has ever been achieved in a Chapter 11 process. So, the team really came together. We focused on a few very important parts of the business that we could control throughout the course of the Chapter 11 process, mainly controlling efficiency of our machines, controlling the uptime, and really preparing for the emergence process, which is, you've seen we mine more Bitcoin than many of our publicly traded peers who have more exahash online. And it's mainly because we took the time to refocus, reorganize the company, and come out a much stronger business, even though we were getting hammered kind of on all sides by, every decision you make in a Chapter 11 process, you need approval of 5 different committees, and each committee has, 10 to 20 constituents. So it's a challenging process to go through, but we made it out on the other side, and we're performing very well now.
Interesting. Yeah, and you mentioned around a high level of recovery. Is that also partly driven just because 2023 was a bit of a bull, like kind of a resurgence year for Bitcoin as well? Like holding Bitcoin on the balance sheet was what enabled some of that, or was it other factors coming into it?
So the interesting part is we actually had to set the valuation about 5 months before we emerged from Chapter 11. So it was still a very high recovery, even though we set it back really, I believe it was back in either August or September timeframe, and we emerged in January of this year. So, part of it was a little bit of the run up in the price of Bitcoin definitely played a role in that. But also the fact that we were continuing to mine more Bitcoin per exahash over the course of that time period, which allowed us to show to the courts, to all of the committees, we're producing a significant amount of free cash flow. And it was really interesting, right? Like we paid well in excess of $100 million in bankruptcy fees over the course of 2023. And we were paid for all of those. We paid down over 40 million in our DIP financing, which is the financing you get when you go into a Chapter 11 process. And we were able to put additional cash on balance sheet. So as a company, we produced a significant amount of free cash flow, and we were able to show, truly how good of a business we were. And it's hard because you go into a process like this, bankruptcy judges aren't familiar with Bitcoin mining. They're not familiar with Bitcoin. They don't know what you're doing as a company, and they're reading headlines about crypto companies are going down. Like we filed kind of in the same time period when all of the major bankruptcies were occurring, whether it be FTX, whether it be Three Arrows, all of those things. So you kind of get lumped into I would say a pretty negative circle, when in fact we were a very strong business just with the wrong capital structure.
Interesting. Yeah. Okay. And I guess one other thing in terms of, well, I guess a couple other questions I have in terms of how things went down. Now, again, I understand this is before your time as CEO, but I'm curious that at that time it was seen that there was no need to have like hedge exposures for things like cash flow or market or foreign exchange risks. Do you have any idea as to why that was? Was that just the prevailing thinking at the time, or was there some reason for that?
Yeah, 2021 was a crazy time period for public companies. You look back at that period and people were putting out major growth targets. It was a growth at all costs type narrative, right? Public investors were valuing companies off of proposed exahash targets, regardless of whether they could be paid for, regardless of the amount of dilution that would need to be incurred. All of those things were not positive in the long-term outlook of Bitcoin mining businesses. As a Bitcoin mining business, you have to be much more thoughtful about how you operate the company. You operate very similar to how a commodities business operates. You have an input commodity, you have power, and you have an output commodity of Bitcoin. And so managing that input and output risk is something that commodity companies do every single day. Now, the problem is back in 2021, 2022, there weren't hedge products. Like we're seeing today, a number of different hedge products come out that are very attractive. We're also seeing much more liquid options markets on Bitcoin. So all these things are huge net positives for operating Bitcoin mining businesses. Now, how do we take from what happened in 2022 and port it over to 2024 so we don't make the same mistakes? You're absolutely right. It's the opportunities that are involved with hedging, forward production, hedging the power side of your business. Both of those are very important components if you want to have a Bitcoin mining business that can actually last 10, 20, 30 years. Because if you just think about it in a very short time period, like kind of the mindset was back in 2021, you're going to fall into the same trap that most of the companies fell into back then. And so that's really what we're focused on now, is how do we continue to evolve the business from the perspective of including hedge products, including, be doing much deeper dives in the power side to ensure that things like happened in 2022, like the invasion when Russia invaded Ukraine, natural gas spiked and put power prices up 100% or 200% in many different locations in the United States. That alone could hinder a Bitcoin mining business significantly, especially now that we're in a post-halving environment. where hash price is much lower. So, there's a number of variables that managing those much more actively is required to run a successful Bitcoin mining business.
Yeah, so we could almost say the industry has evolved since the 3 years ago, let's say, and I guess there, as you said, there was this growth at all costs, and that was a very much a prevailing narrative, especially amongst large public mining companies. I think there was also a concern for from the kind of Bitcoin ideological perspective of we want it to be decentralized, we don't want it to just kind of be all these to be overly centralized into large public companies. We want there to be a kind of a good mix of different entity types, I guess. I guess at that time, that kind of aggressive bidding arguably pushed out a lot of smaller players as well, didn't it?
It's really hard to know. So if you look at publicly traded mining companies as a percentage of the total Bitcoin exahash, we've actually dropped from around 30% over the last 2 years to around 20%, and actually have dipped below that. So you take the companies with the best access to capital markets and the best access to equity capital, and we've grown slower than the Bitcoin network. So there have been a number of other players that have come into Bitcoin and have actually been able to grow faster than publicly traded mining companies. And when you look at the growth targets, you have to say, okay, if public Bitcoin mining companies in the United States are growing this quickly, someone else is growing even faster. And so I think what you really have to do is take a look back at, public Bitcoin mining companies are mainly focused in the United States. And you have to kind of look back at the history of Bitcoin mining in the United States and port that over to the rest of the world. So initially, when people started mining in the United States, you were mainly locating in geographies where there was manufacturing that had left that county, that state, and there was power available. Bitcoin always seeks out low cost, abundant power. That is the nature of the Bitcoin mining network. And so initially it was attracted to those locations, much smaller locations, some were bigger. Then as it evolved, Bitcoin mining companies started to seek out large sites specifically for Bitcoin mining where there was that low cost, abundant power. But now what we're seeing is, those are getting edged out. There's not many locations left. You're competing against large data center companies that are also competing for very similar power structures and quantities of power. And so what you're seeing now is the hunt for smaller locations amongst Bitcoin mining companies. And it's going to be the advantages of being able to scale a large number of sites, not a single site with a large number of megawatts, but can you scale efficiently with a large number of sites with a smaller megawatt footprint? And so that's what you're seeing across the United States now, is really that shift to these smaller sites. And that's what you're seeing you're kind of seeing the early innings of this now across the world, where you saw the initial move into manufacturing sites. And now you're talking about many new countries being added to the mix. Paraguay is one of them, where it's now they know where large amounts of low cost, abundant power are. And so companies are beginning to move to those locations. But soon they're going to have to distribute out much more widely, be much more reliant on what I would say is esoteric opportunities at a much smaller scale. And that's going to help push the distribution of mining to a larger number of players, because these opportunities are edged out in the United States. There's not that many locations left. And so you're going to have to look globally, and that's going to bring a number of new counterparties into the mix. And I think that's actually going to push the distribution of Bitcoin mining to a larger number of players managing much smaller facilities.
Interesting. So if I could summarize then, would it be fair to say it's like there's low-hanging fruit, and some of the low-hanging fruit has been picked, and now people have to sort of go higher up the tree, and that's where the smaller sites, this point that you're making?
Yeah, that's exactly right. That's exactly right.
Interesting. Yeah, okay. And so let's talk a little bit about the capital structure point you were talking about, because this is another point that I think for years there's been this kind of idea, people have said, Bitcoin mining is going to mesh with energy. And another way, and maybe that's also true, but maybe another way to think of it is also it's about the capital. People want to go closer to where they can get cheap cost of capital, because you need cheap energy, you need efficient mining rigs and mining machines, and also capital. And so I think if you could maybe elaborate on the capital structure point, why does that matter? What is it going to look like as we go into the future?
Yeah, capital structures are going to continue to evolve in this business. And I think what you're going to start seeing is actually capital structures paired up with longer term hedges on the Bitcoin side. So whether that be Bitcoin denominated debt, because it's much easier to forecast out what potential difficulty looks like on a go forward basis, because you generally know what the manufacturing schedules are for some of the larger manufacturers. And so you can generally kind of forecast where network exahash is going to go. We have some idea about where efficiency is going to go over time. And so if you can center around for Bitcoin production over a 2 or 3 year time horizon, it actually provides much greater visibility to a debt holder who knows how much Bitcoin they're going to receive and can hedge whatever parts of that debt instrument they want to accordingly. Now, if you can't match those up, the next step is you have to say, if it's going to be US dollar denominated debt, it has to be long enough dated where you can go through multiple cycles that Bitcoin goes through, it feels like every single year, in order to be able to maintain liquidity and have enough, I would say, flexibility around the financial covenants where any downturn in Bitcoin allows you to actually produce, go in, make counter-cyclical investments into Bitcoin mining, whether that be machines, whether that be infrastructure, at points in time when that infrastructure is much cheaper, those machines are much cheaper, to actually perform even better during the next bull cycle. And so those are the opportunities that you have to look for in a capital structure. For instance, coming out of our Chapter 11 process, we had much longer dated debt. They also put in a significant amount of optionality into our capital structure so that all of our debt goes away if we perform, I would say, moderately well, right? And so that allows us the opportunity where if Bitcoin performs well, we essentially become a debt-free company. And so that's something that also should be thought through when you're structuring a Bitcoin mining business, is having the flexibility to have a longer dated capital structure, but at the same time, build an optionality into that capital structure so that if Bitcoin performs well, you can be a debt-free company. And that's something that your equity holders will appreciate as well, because they're willing to say, yeah, at a higher price, for example, yeah, we'll give up 30% of the company. If Bitcoin goes to $100,000, we're willing to give up 30% of the company at that at a much higher valuation, because it was worthwhile to make that bet today. Because we are a leverage play on Bitcoin, essentially, because what we say is we're going to take in the equivalent of one Bitcoin worth of value today, and we're going to produce a multiple on that over the course of the next 1, 2, 5 years. And so that's really how you have to think about capital structures, is time and optionality. If you have both, it actually provides for really an optimal capital structure for Bitcoin miners.
So one other question I have, now we say this now, rates are higher, but if, let's say, rates were to come down over the next few years, would that change this calculus? Because then you would sort of have this option now of, okay, debt is cheaper now. Is that going to then change? Obviously, you're at least more willing to consider using debt as part of the structure. Would that change your view?
Yeah. I mean, cheap debt would definitely be intriguing. You're seeing it with a lot of the convertible notes that, for instance, MicroStrategy is putting out. They're getting very, very cheap debt on their convertible notes because investors believe that Bitcoin will go higher in the future and that they'll be able to service all of their debt that they currently have in their balance sheet. Now, when you look at our capital structure, whether it be high single digits or very low double digits, that is for today for I would say our investment grade and the volatility in Bitcoin. I would say that's about where rates should be. Now, if rates come down, I would say unless we're getting significant term on that debt, I would say debt isn't necessarily the best capital structure, period, for Bitcoin miners, right? Like, servicing US dollar denominated debt is always a challenge for Bitcoin miners. Regardless of the environment, it's something where you need to have a significant amount of time to withstand volatility. And if interest rates do come down and you're willing and you can actually get term on that debt, then yeah, it's definitely a more interesting opportunity. But even going back to 2021, the interest rates were very low. And many miners still struggle to pay off their US dollar denominated liabilities. And so that is also something you have to keep in mind, is that you always have to be hedging accordingly and putting enough cash on balance sheet to be able to withstand the long-term volatility of Bitcoin.
Back to the show in a moment. This show brought to you by CoinKite.com, the creators of the best Bitcoin hardware security devices, such as the Cold Card Mark IV and the new Cold Card Q. Now, we use Bitcoin hardware security devices to keep our keys offline, our private keys offline. Now, the way these work is you can do that setup, write down your 12 or 24 words on the seed word cards, and keep that secure. Now, you can use this device to interact with the Bitcoin network using software such as Sparrow Wallet, Electrum, or Vector Desktop, or Nunchuck as a few examples. Now, you have a range of security features that you can use with these devices, such as passphrases, you can use seed XOR, or my favorite is multi-signature. Now, if you're starting in a basic way, just start with the device and the USB-C cable, plug it directly to the computer and use it that way, and then later improve your setup. But I believe these devices are great at helping secure your coins, especially as you start to migrate up into multi-signature security. But don't be disheartened or don't be scared away. They are accessible, and I think you actually do learn about Bitcoin in the process. So to get yours, go to coinkite.com, use code Livera to get a discount on your cold card. This show also brought to you by Mempool.space, the leading Bitcoin and blockchain visualizer. I use it all the time when I'm checking transaction fees and trying to understand what is the state of Bitcoin's mempool. You can search transactions, historical as well as unconfirmed ones, and also see a great way to visualize things across the Lightning Network, Liquid, mining, and so much more. Also, for those of you with an enterprise, they offer a Mempool.space enterprise program. So for those of you as part of that enterprise program, you might want to get increased API limits, and you might want to have increased access to the team in terms of feature requests. You might want to have special branding in terms of how your custom instance of Mempool.space looks. So to sign up for that, go to Mempool.space/enterprise. With the efficiency comments as well, so you were talking about this idea of planning out ideally if you can have long dated debt and understanding where Bitcoin mining machine efficiency is at today, and obviously you have to make some kind of estimate about where the future is going to be, and of course how much a new hash rate is going to hit the network and come online. I'm curious if you are looking at, well, I'm sure you are, but do you have any thoughts on where things are going, like with the new 3nm chips that have been announced by some of the different competitors there?
Yeah, I mean, efficiency we know is going to come down in 2025. I would say the main theme right now is that 2025, I think, narrative around Bitcoin mining is going to be the democratization of hash rate. So what I mean by that is there's going to be new manufacturers entering the market and bringing 3nm chips to the broader Bitcoin mining space in a way that's not just Bitmain and not just MicroBT. And so you're going to see larger Bitcoin miners begin to explore what other options are in the market. So you're already seeing it today with the announcements around whether it be Marathon and Ordine or any of the other announcements. Block just announced their 3nm chip as well. And I think all of this is very bullish for Bitcoin miners. But what you're actually going to see is the bifurcation of strategies between different manufacturers. So you're going to see, the traditional manufacturers, they price on an ROI basis. So they take a point in time and they say, we price our machines based on what we believe an ROI is on this machine over a 12 to 14 month time period. Now, some of these new manufacturers are saying they're going to approach this from a cost plus basis, much more similar to how the traditional technology is sold in the market today, whether that be servers, whether that be GPUs, etc. And so what you're going to see is you're actually going to see different cycles amongst manufacturers in a way that we didn't see these in the past. We saw cycles for Bitcoin miners who were able to make very large investments during bull markets because they were able to raise a significant amount of equity capital. But now you're going to see it on the other side as well, where cost plus folks during a bear cycle are going to be overpriced in the market, but the ROI players are going to be able to price much more competitively. And on the converse, if we go into a bull cycle, all these cost plus folks like Block, for example, are going to be able to be extremely competitive and be able to grab a significant amount of market share. And so I think that's really the most interesting narrative that we're going to see going into 2028 in the next halving is how have these different manufacturers altered their strategies to be able to be competitive through different types of cycles.
And as you pointed out as well, that there's more Bitcoin mining manufacturers who are entering the chat per se. That there's new players coming where I guess historically it has been very much a Bitmain or MicroBT sort of dominated industry. So do you see any strong competitors coming? Do you see that as they're going to be more viable and it won't be as much of a 1 or 2 horse race?
I mean, the people that have come into the market, I've been following this since 2017 in terms of new manufacturers coming to market. Now, we've seen plenty of failures throughout that time. Nearly everyone has failed over the last 7 years in terms of trying to bring a competitive machine to Bitmain. We've seen MicroBT even struggle to capture market share against Bitmain. I mean, now what we're seeing are very adept ASIC designers and design teams that have been successful in dozens of tape outs for other products coming to Bitcoin mining because they can actually do it from a scale perspective. They have the relationships and they can raise the capital because investors have watched them be successful across multiple other types of design. And so that's something that I think is most interesting is now these companies, these new manufacturers are well capitalized. You take a team like Chain Reaction, for example, multiple extraordinarily successful tape outs and exits. And so that's something that the market believes in them, large investors believe in them, and believe that they'll be able to make a competitive chip to what Bitmain's able to produce. Now, Bitmain is the 800-pound gorilla in the room. They're very hard to catch up to. They have the expertise, they have the relationships, they've really almost never missed in terms of bringing the most efficient machine to the market before any other manufacturer. But you take someone like Block, for example, who has significant ASIC design team, significant capital, and are a much larger business than Bitmain is. And if they're dedicating the resources to be competitive on this side and are dedicated to the long-term vision of building a machine, even if, let's say that they have 1 or 2 missteps along the way, well, then Block over the next 10 years is going to be able to grab a significant amount of market share because they have the team, because they have the capital. And if they're able to execute, during bull markets, they'll capture more market share, I think, than most people expect them to be able to capture. Because if they're priced at a significant discount to what Bitmain is, for public mining companies or any other mining company across the globe, if they look at the ROI and say, well, it's 10 months on a Block machine, but it's 18 months on a Bitmain machine right now, you're going to be very hard pressed to find someone that's just willing to jump to Bitmain at a time when ROIs might be much, much cheaper on a different manufacturer's machine.
Do you have any anticipation for how, again, it's hard to predict. None of us has a crystal ball, of course, but if we sort of see another bull cycle and we see the hash price go crazy like it did, do you see a similar thing happening again, that that same kind of dynamic could happen, and then it's more the scarcity is being able to actually get mining machines at that point? Do you see that kind of thing as a possibility for this few years?
Yeah, it's absolutely a possibility. I mean, we're in an interesting part in the cycle. Infrastructure is extremely constrained. So you're watching other public mining companies acquire facilities that have 5-6 cent power. I consider those really bull market sites where they're very viable in bull markets. The other part is what we've seen amongst machine pricing is anything that's not the newest generation machine nearly got cut in half post halving in terms of its pricing on a dollars per terahash basis. Now, those machines are extremely competitive and the efficiency is not far off from the newest S21 that's out there today. And so watching the dynamics, it's extremely interesting. If you don't own your infrastructure, you're going to have a very hard time aggregating infrastructure over the coming years. And I think that's going to be one of the main narratives. If you control your infrastructure, if you have all of it today under your control, you're in a much stronger position because acquiring machines right now is a much easier thesis than trying to say, well, we're going to buy 500 megawatts or a gigawatt of power and bring all that infrastructure online. If you think about the supply chain constraints, we compete directly with the traditional data center industry for equipment. And there's no larger narrative. You pull up in Bloomberg, Wall Street Journal, Reuters, any publication, and they're all talking about the supply chain constraints for traditional data centers to bring things online. And so I think that's going to be the big narrative over the next kind of 18 to 24 months is, do you control your infrastructure? And if you do, is it actually low cost to be able to survive through a bear market? And then the people that do control their infrastructure, the narrative for them is, how much exahash can you acquire during what I would consider really a counter-cyclical time period? We have hash price sitting at about 5 cents today. And so can you acquire enough machines so that you can be there for the next bull market where exahash can't catch up to Bitcoin price? Because Bitcoin miners play for a very short time period where Bitcoin price outpaces hash rate growth. That's what we try to survive for, right? Because during that time period, we make outsized returns. Now we have to be able to survive the 3 to 4 months that happen every single year where Bitcoin price is falling, but network exahash is growing. And so you have to build a business that is, bear market, I would say, fortified, but also be in a position where during those bear markets, you can make the necessary investments to be prepared for the next bull cycle where machine pricing goes exponential over a very short period of time. And if you don't have the infrastructure to plug in, you're not going to be able to bring that infrastructure online during that short period of time where Bitcoin price would be outpacing hash rate growth.
Yeah, really interesting. As you said, that during the bear cycle, there was this incredible opportunity. If you were around, that you could buy up these machines, right? The Bitcoin mining machines at a great discount. But the thing is, you had to survive to be there at the time and have the capital and have the structure, to your earlier point, to be able to execute that. And that's just at the machine level. Then, as you mentioned, there's also the rack space scarcity, or having data centers. And I presume now there's also, as you mentioned, there's a lot of competition on the data center side, the AI side. I believe I did see a news article on Core Scientific on the AI side as well. So if you could explain a little bit on how you're balancing being a Bitcoin mining company, but also doing AI.
Yeah. So if you look back at the roots of our company, we started by seeking out low-cost, abundant power. Now, much of what we were using as a criteria for locating sites was a much more traditional data center approach. And given that we were the first institutional Bitcoin miner in the United States, we had to figure out what the design was going to be for our facilities. So what our team did, given we were a traditional data center team, we essentially took the traditional data center model and said, how do we strip this back and make it suitable for Bitcoin mining? Now, as this company has evolved, we've moved from being a hosting company for Bitcoin miners to being one of the largest self-mining companies in the United States and the largest owner of infrastructure for Bitcoin mining. And really the next evolution is, how do we continue to ensure that we're maximizing the value of the assets that we own today? And so we're looking at this broader narrative shift, and our we believe was our kind of esoteric thesis back in 2023, which is we're going to see this shift to smaller locations for Bitcoin mining as some of these larger power opportunities begin to get edged out in the market. And so what we're looking at for some of our existing sites is the conversion of certain facilities to HPC applications. Now, that doesn't mean we're not committed to Bitcoin mining. We'll continue to be able to grow our Bitcoin mining footprint, given our software stack, given our team, given our site selection team, because what we want to do is make sure that we have a sustainable Bitcoin mining business, not just for the next halving, but the halving after. And to do that, you have to say, what is the power cost at that location? And what are the structures that will allow for you to actually operate machines profitably at the next halving? And so for us, we're looking at certain sites that we own and say, these have been amazing sites for 7 years, but 4 years or 8 years from now, do we believe they'll be competitive for Bitcoin mining? And so what we're looking at today are certain types of HPC contracts that will have long-term steady cash flows that will actually improve the stability of our company, hopefully bring down our cost of capital, and actually make us even more competitive on the Bitcoin mining side. Because if you have a large, stable business paired with a Bitcoin mining business, it allows you to be much more flexible. And we have covenants today that restrict us from holding more than 10 days worth of Bitcoin production on our balance sheet. we believe through the execution of these HPC contracts, we'll be able to drive enough shareholder value. And I talked about optionality earlier, to actually trigger the certain options that are embedded in our capital structure to pay down our debt, to actually be able to put Bitcoin back on our balance sheet. Because we do believe that there's a necessary component of your balance sheet that should be dedicated to Bitcoin. And so we believe pairing HPC with a Bitcoin mining business will add greater stability and actually add a significant amount of value, not only in the short term, but also in the long term to our shareholders, who can say, well, at the very least, they're going to be able to produce a significant amount of cash flow during bear markets, given the HPC business, which will allow them to make counter-cyclical investments back into Bitcoin mining at a time when other companies struggle to raise capital.
Yeah, that's interesting because it seems that, as most people are aware, Bitcoin mining is just a brutally competitive business. And so people are looking for whatever edge they can find, whether that is using the waste heat as part of how as part of how you make the business work. But in this case, it sounds like for some of the large Bitcoin companies like yourself, it's this HVC aspect that you can maybe have that as like another aspect of the business that is more consistent in terms of returns, ideally, such that you are then able to use that consistent return in order to make the required Bitcoin investments, whether that's rack space or Bitcoin mining machines or other operational Bitcoin mining costs.
Yeah, you're absolutely right. If you have a business that's generating, let's call it several $100 million in free cash flow per year, that frees up capital to be able to deploy capital into a separate business that has much greater volatility. But if you're always able to make those counter-cyclical investments, that's going to present a much different thesis for your company than a traditional Bitcoin mining business, where when you go into a bull market, equity capital markets are very thin, and you have a much harder time raising capital at a low cost of capital, right? Because if you're in a bear market, how lenders are going to price your debt is going to be very expensive. And so that provides us an opportunity to actually build out an even better Bitcoin mining business by pairing it with a stable long-term free cash flow generating business.
So how would you compare Core Scientific with some of the other large public Bitcoin miners? What's Core Scientific doing differently?
Yeah, I think our secret sauce is in really two areas. It's in our platform, the assets that we've acquired today, and our ability to maximize the value of those assets, and then the team that we've put together to surround those assets to figure out how we actually execute on a long-term vision for this company. So we've been able to bring together, I would say, the main components of a very strong digital infrastructure company. We have our own in-house software team, so we've built all three levels of our software stack. So that's energy management, fleet management, and our own firmware. And we're able to integrate all three components to actually make our data centers, I'll call it, much more smart than other Bitcoin miners are. So we're able to take into account wind speeds, humidity, pressure in our facilities, all of these different variables to actually optimize the firmware settings on our machines. And we're always setting them to maximize profitability. So they're able to intake different types of power programs that we participate in. And we're able to take in all of these weather variables. And we're actually able to say, well, if we actually change the firmware settings on this machine, we can generate X amount of additional Bitcoin per day above our competitors. And so that's something that provides us a significant edge. On the other side of it is our operations team, which comes from the traditional data center world, where downtime is not acceptable. And so they've taken a much different view than most Bitcoin miners who, started with, let's say, a 5 megawatt facility, have grown to, let's say, 200 or 300 megawatts today. And they're just figuring out what the major issues are with controlling 300 megawatts of power. Whereas you take our team, and our teams run over a gig of data centers in the traditional space for some of the largest data center companies in the world. And so you pair all these components together on the operations and technology side, and we have a much more compelling team and ability to execute on our future growth plans than really any other competitor in our space, who are trying to just find right team members to keep their machines online. We're very far past that. We're focused on what is the next generation facility like? How do we optimize our machines in the future? How do we take chips that might be being designed today and put them on hash boards that are designed specifically on a location by location basis to be optimized either for the 100 days that are sub-zero at our Grand Forks location, or the 100 days that are above 100 degrees at our Cottonwood Pecos location in Texas. Those are much different environments, and we have different things to optimize for, but we've done it all around the country in a varying, I'll say, environmentals type environment where we have to control for all of these different variables, but we're focused on the future. Well, most of our competitors are focused on just solving the problems in front of them today.
Back to the show in a moment. The lead sponsor of this show is Swan.com, and Swan has a mission to onboard millions of people into Bitcoin. I also work at Swan, helping on some educational content for the team. Now, the team have also put out a new version of the Swan Bitcoin application, which is available on your smartphone, whether it's Apple or Android. Now, this app has a really fast onboarding experience. It's now just a few minutes to go from zero to Bitcoin. So if you are standing there with your family or friends and you might have been having trouble trying to get them onboarded, well, try this now. Recommend Swan Bitcoin. And you can do this while you're standing next to them. They can click through, and most of them will be able to set up and do this in just a few minutes. Also, the team at Swan have rolled out a new promotion. There are 0 fees on your first $10,000 of Bitcoin buys. So this is a great way to go from zero to Bitcoin, and in a guided and managed way. So reminder, go to your App Store or Play Store and search Swan Bitcoin to get onboarded with Bitcoin today. This show also brought to you by Nomad Capitalist. Nomad Capitalist is a leading provider in terms of offshore tax and lifestyle strategy planning and implementation. They can help you go overseas and legally lower your taxes. As many of you know, I grew up in Australia, but I left. I was sick of it in terms of the taxes and the COVID tyranny and all these other things. And so that's why I left, and now I live in Dubai. But that's not necessarily the place for you. You have to think exactly what works for you, for your family, for your business. And Nomad Capitalists have worked across dozens of different countries. They've helped people get passports, residences, bank accounts, and all kinds of other things. And importantly, it's not just about choosing one place. It may be multiple places. And it may be also about making the pieces fit together in terms of how your business fits with your family and you as an individual. Nomad Capitalists have helped many people in terms of going overseas. And if you're interested, go to nomadcapitalist.com/apply. This is applicable for people with a net worth above $1 million US. That's nomadcapitalist.com/apply. One other topic that's really prominent now amongst Bitcoiners is maybe around the pools and the centralization concern. So there's been some recent news that, a bunch of pools are pointing their hash rate and it's to Antpool, and that it's not really a very decentralized ecosystem. And that spurred a lot of discussion about things like Stratum v2. Now people debate on how effective that will be, and also the type of mining pool payout, right? Is it an FPPS payout or a PPLNS payout? So I'm curious if you have any thoughts to share around Bitcoin mining centralization and this broader idea of censorship resistance. Do you view that as part of what gives Bitcoin its value? Is that something Core Scientific is looking at?
It's definitely something we look at. Understanding Bitcoin mining pools is something that I would say has been it's definitely been in focus more recently. I would say the knowledge around Bitcoin mining pools across the network is, I would say there's a lot more education to be done. Folks like Foundry, Luxor, etc., they're very collaborative with their teams. They take into account all of our input in terms of when we're voting for certain types of upgrades to Bitcoin. All of these things are really important to have. I would say over time, I think Bitcoin mining pools are probably going to become more decentralized. You've seen folks like Marathon introduce their own pool. I think it's the biggest challenge when we think about it from a public mining perspective is investors today don't understand variability in payouts. And that's probably the biggest risk. You can take a pretty good case study. You can take Riot. Gosh, it was back a few years ago. They were operating on a pool that had much greater variability in their payouts. And so this is something where public investors don't necessarily understand this. And so over time, what we've seen is if you can provide greater clarity to the market, investors are much more comfortable. And so I would say that's probably my biggest concern going forward is the education around pools, because there's a significant lack of knowledge amongst most even Bitcoiners on how pools operate, how much control do they actually exert. And over time, I mean, I think the bigger concern in terms of control over the network is, how much of the network is actually controlled by a very few parties. It's not really public Bitcoin miners. If you look at the hash rate, I mean, I would say, there's a number of private miners that control a very significant amount of hash rate that is probably more dangerous to the long-term health of the Bitcoin network than pool centralization. And so I think that would be my focus over pool centralization, because you're absolutely right. Antpool controls a significant amount of hash rate on the network, but also that hash rate is owned by maybe 1, 2, or 3 parties. Whereas you take someone like Foundry, and that's distributed amongst, maybe 50 or 100 different parties. And so much different structure, much different, I would say, incentives in terms of their voting power. And so over the long term, I think it's more about decentralization of hash rate over decentralization of pools.
Interesting. So, I mean, one thing there, though, with the, I guess, pools that exist, or at least companies that exist under, obviously, government regulation, it's, I guess maybe a concern could be around if the state orders people to use a certain kind of pool and that pool does censorship, then that's not really going to, move the needle much. And in that case, the private miners are kind of a good thing, arguably, because they could at least, if one pool starts to censor, they could at least point their hash rate somewhere else. So I guess that's at least one part. That's an education thing. But certainly public miners, we would say, are kind of, they are at the behest of the state. But maybe there's another angle there. Maybe there's an education angle amongst, lobbying and politicians and the everyday people of, why this kind of the freedom aspect of Bitcoin. I'm curious if you have any thought on that.
Yeah, we get asked about this a lot, just related to, do we believe that there should be greater censorship on the network? Our goal as Bitcoin miners are to secure blocks, kind of full stop, right? We don't choose transactions. And from our perspective, if you're willing to pay for a block space, you should be included in a block. And so whether that be any of the other, I would say, new items that are being brought to Bitcoin today, like ordinals, runes, etc., or whether it be transactions, right? We just support the long-term security of the Bitcoin network. And whatever that's kind of the beauty of Bitcoin, at least from my perspective, is the ability for any type of data, whether it be transactions or whether that just be raw data, to actually be put on to the Bitcoin blockchain. And so if you're willing to pay for that space, you have a right to that space. And I think that goes counter to a number of other Bitcoin miners that have been much more vocal about, taking out certain transactions that are included in Bitcoin blocks. But I think over the long term, I think there probably is going to be greater regulation from whether it be the US government or other governments. But that's going to create an opportunity for other Bitcoin miners to actually be much more successful in terms of being able to capture greater fees from counterparties that certain companies or certain geographic locations don't necessarily want included in their blocks.
Right, so it's a geographic decentralization point that maybe one state says you can't mine this transaction, but another state, as in nation state, when I say state there, not US state. But yeah, okay. So yeah, and of course there'll be disagreements around ordinals, inscriptions, runes. Some Bitcoiners would view that more kind of like a spammy use case and not really like, but that's kind of getting into the debate of whether it's filtering or censorship. I think it might be also interesting to talk about fee dynamics as they change over time, right? Because as I'm sure you're well aware, a lot in the early days of Bitcoin, it was a lot more subsidy driven. And then over time, that's obviously coming down with every halving, and the system is going to transition more to a fee-based system. So I'm curious if you have any thoughts on what does that look like as we transition to a more fee-based and arguably uncertain, because you can't predict that.
The next halving is going to be, big question mark for miners if it's not a fee-based system, right? Unless there's a massive run up in the price of Bitcoin, fees have to come up in order for many Bitcoin miners to be successful. And I'm not saying the entirety of the network, because over time, as machines become more efficient, that actually requires a lower break-even hash price. And so over time, it's okay for, I would say, Bitcoin-denominated revenue to come down. But that also means that either Bitcoin price or transaction fees have to increase. And so by 2028, we have to see, I would say, nearly equal transaction fees to block subsidies in order for many, many miners to be successful. Now, maybe the case is that by 2028, we don't need as much exahash in the network. I mean, at this point, we're unbreakable. I think even if 50%, 75% of Bitcoin mining exahash came off the network, Bitcoin's still unbreakable at that point. It still would require over a year's worth of all of the production out of the chip manufacturers, gigawatts and gigawatts of power in order to actually break Bitcoin. And someone would have to do that in secret. And we all know for a fact that what we would actually see is them just join the network anyway and push up difficulty, but it's much more profitable to do that than break Bitcoin. And so I think, some of the things that we've seen around the volatility is actually we're going to start to see option markets for transaction fees going forward. So you're going to see people actually hedging out their transaction fee risk. And it's even something that was discussed around the halving, which was, are you willing to take, let's call it X amount of Bitcoin in exchange for paying out whatever Bitcoin you receive out of your transaction fees? And I think that is actually an interesting, I would say, segue into what we're actually going to see in the future, which is by the time we get to 2028, option markets are going to be much more liquid on Bitcoin mining products. And we're actually going to see probably separate products for transaction fees. And our hopes is, as Bitcoin miners, that transaction fees continue to move higher over time, and that things that need to move to an L2 move to an L2, and things that want to be on L1 are willing to pay for that block space. And hopefully it's commensurate or a commensurate level where we're actually able to continue to operate profitably, and not just with the newest generation machines. I think that's something that many people don't understand in this business, is that we're constantly refreshing our machines to move into the next generation equipment, whether that be every 3 to 5 years. And there are certain time periods where under many power cost structures, you're really only viable with some of the newest generation equipment. Now, we're not there today at a 5-cent hash price, but if we go down to a 1 cent, 2 cent hash price for an extended period of time, there are very few miners that would be actually able to withstand that type of move lower, given cost structures with power contracts, given their existing generation of equipment. All of these things take hundreds, or I would say tens of billions of dollars to upgrade across the network. And you're just not going to find the capital to deploy into the network if that actually occurs, right? If we flash down to 1 cent for an extended period of time, there's not going to be that amount of capital to actually go in, deploy into new machines, deploy into infrastructure to actually eat up a greater percentage of the network.
I see. Yeah, I mean, at that point, I guess it would just be about survival for a lot of miners, as opposed to trying to expand their operations.
Yeah, you're absolutely right.
Yeah, interesting. Okay, so we've spoken about a bunch of different things. I guess, the other aspect, of course, is obviously the price could rise over that next 4 years, right? Like, on average, if the price doubles, now, it may not happen forever, right? But for the next few cycles, if it doubles, at least at the fiat price level, then you're like that is another lever, I guess, that can, not that we can pull that, but that's another, I guess, variable that goes into the cost calculation.
Yeah. I mean, so hash price, US dollar denominated amount that you're receiving per terahash of exposure that you have. And so a really good way to think about it is, if Bitcoin price goes up, hash price actually goes up alongside of it, holding network difficulty constant. And so if we continue to see Bitcoin price increase, the hash price that we experience will actually increase alongside of it. And for Bitcoin miners, we have relatively fixed hash prices, or hash cost, I should say. So our cost to mine is relatively fixed on a from a cost perspective. And so that means as Bitcoin rises, we have actually the opportunity to actually generate a greater margin, reinvest in equipment. But that actually in the long term brings down hash price. The more hash rate we bring online actually brings hash price down.
Yeah.
And so it's kind of the self-regulating network. We always talk about it. Well, if hash price goes low for 3 months, it can't really stay there, right? Like something has to give, whether it be hash rate coming offline or Bitcoin price increasing. And so we've seen over time hash price come down, since the beginning of Bitcoin, but that's something that we all expect. And as we migrate into newest generation equipment with greater efficiency, we actually can make a similar level of gross margin on a lower hash price if we have a more efficient machine. And so we're going to see this trend go lower over the course of time. And it is actually something that we're all planning for today. And so it's not like, something that is kind of outside of the bounds, but hash price volatility is extraordinarily high. Over the past 4 years, we've probably had, let's call it a 15 to 18 cent hash price, average hash price. And today we're sitting around 5 cents. And so we've definitely seen it come down, but we've also seen spikes where we saw hash price immediately post halving go up to 18 cents. And that was with the lower block subsidy. So hash price volatility, going back to an earlier point that you brought up, hash price volatility is going to continue, and it's mainly driven by transaction fees, less so by network difficulty.
Yeah, interesting. And as you were saying, right, around the halving, there was a massive, amount of runes happening, and there was just a huge spike. And I think most people predicted that there would be this spike. The question was, would it sustain? And I think that's what we're sort of seeing now. And arguably, there's still a decent amount of runes. I would call it spam or shitcoin scams, but it's there and I can't stop it. So I accept that. So any closing thoughts for listeners?
I think it would be mainly around what do Bitcoin miners look like in 2028. I think the best way to think about it is this network is going to become continuously decentralized, and it's on a site level. I think a lot of people see the news around mega sites going up and think, the entire network's becoming more centralized because 2 companies are putting up, 500 megawatts or a gigawatt of power. When in fact, over the next 3 to 4 years, what we're going to see is greater decentralization across smaller sites. And I think that's actually going to take away a significant amount of volatility in what we see in network exahash. Because, for example, like when the Texas grid becomes very expensive, 15 to 20% of the network comes offline. But Bitcoin miners going forward are going to be focused on more decentralized sites, which are going to, I would say, produce more consistent Bitcoin production. More consistent Bitcoin production is going to bring down the cost of capital for Bitcoin miners. And what you're going to see are much more stable Bitcoin mining businesses in 2028 than we've seen over the past 7 years in the United States. And so I actually think this is a long-term bullish signal for Bitcoin miners who are going to be able to say, we can withstand extreme volatility in our business. We can withstand lower Bitcoin prices. We can withstand lower hash prices. And I think all of this is much more bullish than most people realize, because the Bitcoin network is going to continue to become more decentralized, and miners are going to continue to ensure the long-term security of the network.
Great. Well, thank you, Adam, for joining me. Listeners, links will be in the show notes. It's corescientific.com. Adam, thank you for joining me on the show today.
Thanks so much for having me on.
I hope you enjoyed the show. If you did, make sure to give it a thumbs up and share it out there with your family and friends. Check out my website at stephanlivera.com, and I will see you in the Citadels.